Stephen's first idea is Neighbourly Pharmacy, which is rolling up small pharmacies, I think generally in smaller communities. The stock has suffered. You see prospects for a turnaround, Stephen?
Yes, we do. So this is a fairly recent addition for us. It's Canada's third largest pharmacy chain, mostly located in rural communities. And the strategy, as you said, is to consolidate what's still a very fragmented industry and generate operating efficiencies while also trying to grow the top line, for example, in the front of the store sales and additional services. So this is really a defensive growth stock, benefiting, of course, from the aging demographics, but also new revenue sources, for example, from increased scope of practice, where you see pharmacies in certain provinces can prescribe more medication now and offer more services to customers to alleviate the burden in the public healthcare system. And the company went public 18 months ago. $17 got ridiculously overvalued at about $40, but has since come back down to earth in the low 20s. Meanwhile, the company has doubled its revenues to about $830 million and its EBITDA to almost $100 million, and released very good results a few weeks ago with healthy same-store sales and increasing margins. So we feel that in the low 20s, the stock is very attractively priced, considering the strong growth and the margin improvement and the very good free cash flow generation as well. It's trading at about 11 times EBITDA versus 20 when it went up in the high 30s. And there's been significant insider buying in the past few months as well. The main shareholder has been buying shares and also participated in the last financing, which was at $29 when they bought Rubicon, their biggest competitor, who they were constantly butting heads with when they were buying some of these smaller pharmacies. So good potential, safe way to play the healthcare system, and look at it as a defensive growth stock.
Okay, so as you say, it went public, it looks like, at $17 in 2021. And then when shooting up, they did two financings, each at more than $28. Okay, but it's still above the IPO price. Stephen, we're tight for time. Cargojet is your next idea. We touched on this one already.
Right. Well, they're Canada's leading air cargo carrier with over 34 planes, and they've locked up about 90% of the domestic overnight air freight market in Canada. They also offer international subcharters and charters, and they have clients like Canada Post, UPS, FedEx, and Amazon. And they don't take risk. When they buy a plane, it's fully contracted, like a take or pay. So look at it as sort of a contracted pipeline in the sky. And it's commercial business with Amazon. It's e-commerce dependent, but it's still growing double digits in Canada. And they recently announced a very large contract with DHL out of Germany, where they're acquiring 5 additional fully contracted planes. And because it's in the transportation sector, it does oversee business and does a lot of e-commerce with Amazon. The stock's been thrown out with the bathwater, yet it has very high growth, high margin, high return on capital, and it's now trading at only 8.5 times EBITDA. So there's limited competition and very high barriers to entry. So really a very high quality business to buy at a very reasonable price, and take advantage of the fact that it's getting, as I said, thrown out with all the bad news hitting other international carriers.
Finally, Park Lawn, and again, buying up smaller funeral services operations.
Right, it's the only publicly traded death care company in Canada, funeral homes, crematoria in the U.S. and in Canada. They're the number 2 player after Service Corp, who are huge in the U.S. This is a recession-proof business, high margin, high barriers to entry, powerful demographic tailwinds behind it, strong management team with an M&A strategy, and also good operators to squeeze out synergies. And so the company was added to the TSX last fall, and it ran up to over $40 and has come down into the low 20s, partly due to the market correction, especially for smaller companies, and also because the comparable results versus last year are a little tougher this year because, of course, the death rate was higher during the pandemic. But the company is guided towards 150 million of EBITDA by 2026, so 15% compound from here. And it's trading at a very attractive valuation now in the low 20s for a unique business with not just good organic growth, but also good M&A growth as well, and strong free cash flow. So very good time to buy it.